Hello and welcome to this very special episode on the Virtual Museum of the Securities and Exchange Board of India. I'm Mahalakshmi and I have with me a finance industry veteran. He started off as a consultant with McKinsey, went on to become an investment professional with one of the oldest and mightiest private equity firms in India, Warburg Pincus, and then led the oldest mutual fund in the country, UTI AMC, and now he's a banker with JP Morgan Chase leading the South and Southeast Asia operations. And he sits on boards of marquee companies like the Hindustan Lever and also an independent director on Tata Sons, the group holding company for the Tata Group, and several other companies he served as a board member. Please welcome Mr. Leo Puri. Thank you so much, Mr. Puri, for joining me on this discussion today. So, Mr. Puri, we really stand at the cusp of a dramatic transformation in India today in terms of how the economy seems to be poised. It looks like the next few decades could belong to India. And amid this, we have this very uncertain geopolitical climate, and the business landscape is looking at some kind of a total disruption of sorts from the technology side. How do you think this whole story will play out in the next few years?
As you say, Mahalakshmi, this is a very important moment in India's history, economic history. We have a confluence of several positive factors. For the first time, we have a middle class, partly driven by urbanization and rising GDP, which is truly a consumer-led middle class. It's being able to buy services, it's being able to buy goods, and it's doing so increasingly at increasing quality. The second has been a set of initiatives which have created a highly admired technology foundation now for the country. People have identities, of course, thanks to Aadhaar. They have access to bank accounts. They have access to data. They have, therefore, global connectivity. And that's a very powerful change. The third is that India's skill sets, even though education has some way to go, has made us the envy of the world in terms of our ability to provide skilled labor to the world. Almost 20% of the incremental workforce coming into the workforce globally are going to be from India. So in areas of soft services, software services and engineering related skills, people are looking to this country and its youth to provide and meet demand in that area. And finally, of course, India's position in the world as it gains in confidence is enabling it to take advantage of the geopolitics, the desire to seek diversification from existing supply chains in China, find new forms of engaging with India. And that's again a very positive moment. So yes, this is a very exciting time for India and for its middle class.
Sure. And tell me, why is this time? Why is it that this time the world seems to be a lot more confident about India's future than any time in the past?
So some of this is just numbers. It's the most populous country in the world. It's a country that has now broken through in terms of becoming a top 5 economy globally. It's no longer just a top 10 economy. It's probably the 5th largest economy, probably will be the 3rd largest economy. As I said, it's consumption-led, so it's an opportunity for businesses around the world to participate. We have had a shift in thinking within India, which is a work in process towards willingness to liberalize, willingness to globalize, which has caught people's attention and has seen borne fruit. And I think this is why the world now feels India must find a seat at the top table. So we are no longer sitting in the back rows watching the world go by. I think people want us to move to the front of the table. And that's why I think this will be different. I think we have a more permanent, stable place. And I think the thinking within the country and the political system in India is also much more pro-growth, pro-reform. And really, I think that's transformational.
Sure. We'll come back to more about the future, but I want you to just walk down memory lane from the time you started the entire professional career. Tell us from your perspective, how have the capital markets really evolved thus far?
Well, I think it's been a fascinating journey. My history, direct history, really is just post the 92 reforms. So if you take the period from 92 to today, I'd highlight three key elements that I think have shaped where we are. One was the willingness to connect ourselves with the world and move away from a pure import substitution economy. As we did that, we were going to need capital at a far greater pace than we had had before. We were going to need technology, we were going to need partnerships. So this shift led to essentially a willingness to globalize and liberalize for the first time. The second big shift was the necessity of creating new institutions. And this was a period of great institution building. Building we're sitting in now, of course, SEBI got created in the sense of becoming a statutory corporation at that time. But it also saw the willingness to license new banks.
Yeah.
Some of our finest institutions that we have today came into being or got conceived at that point. Some of our other regulatory institutions also got conceived at that point in time. So that was it was an era of institution building to support this shift that was actually happening. And I think the third big shift was the first stirrings within India that you could build an entrepreneurial class for a country that had got used to a form of socialism, that it was going to be okay once again to have business as an acceptable, not just acceptable, but maybe even over time, an aspirational career. And so the talent that had been going into what I would call examination-led professions started to also seek new avenues for the development of capital, which is what brings us to the story that we're here to talk about, which is the development of capital markets, I think was centered around these developments, and it was fertile ground for the growth of our markets.
Absolutely. So tell me if you could just pick out a few highlights from that time that really helped shape the markets the way it is shaped in the last few years.
So I think India has always had a great tradition of markets, market making and trading. It precedes the British, of course, because we've had communities in the north, south, east and west that were naturally inclined towards trading, commodities, services and so on. So it's not a new phenomenon. East India Company bought its own vision of this, of course. It was a joint stock company and brought with it concepts of contract and law, which we then adapted. And essentially you saw the creation of brokers and the famous, Dalal Street, which really came into being in the 19th century. Not everybody realizes that. And the Banyan Tree and Horniman Circle, that is all the subject of legend. But I highlight this to say that it is actually a very deep-rooted tradition in India and not a recent foreign transposition to have communities who are willing to engage in intermediation of goods and services, which is what markets do. So I think what started to happen then was we had already had the development of a stock market. We had a major blow up, so the so-called 1992 scam at the time. And that was a seminal moment because I think the view was that we had to create a balance at a time when we were opening up markets and bringing new savers and households into markets to balance risk and reward in a more direct way. So it was a big shift from the laissez-faire mindset, which was okay when you had a small level of activity that impacted relatively few people. But since the ambition now was to broaden markets, so-called democratization of markets, and this was the beginning of that process, it was now going to require a level of institutionalization and supervision that had not been there before. So I do recall that and the pendulum always tends to swing too far. Right. So when you do this, At the time, it felt like there was a violent, almost counter-reaction that had come into being for a couple of years post the unraveling of the breakdown that had occurred in '92. But post that, and I think this is important because this is how India's markets have developed, it has never been a straightforward or a linear journey. We have periodically encountered severe turbulence. 1992 was one, Satyam, of course, was another.
Yes.
The discussions that are happening around FPI and what should or should not have happened with regard to the Adani Group is a more current example. So these issues will keep happening.
Sure.
But to me, what has been encouraging is that while there may have been a temporary backlash, if you like, from that, our system has been quite wise in quickly re-establishing equilibrium, because the ultimate benefit of the development of our markets is essential for the development of our economy and the well-being of the entire country. So I think that recognition amongst our political system and our establishment, to me, has been the central theme of this journey. And if I can just elaborate on that, it's been about creating institutions that serve that purpose. The stock exchanges, the clearing corporations, and so on, which have given stability and trust to the markets. It's been about evolving regulatory capability and capacity, which is a long journey, but which has been visibly in place for the last 2.5 decades now. And it's been about permitting, or not permitting, encouraging the development of intermediaries who will add their own momentum, bring sophistication, and ultimately, hopefully, expand the pie for both issuers and investors. So this has been, a very, very, I think, well thought out journey, and something that India should be proud of, is the relative stability of its markets today.
Absolutely. So tell me, in 1992, which you call out as an inflection point, you were perhaps with McKinsey at that time?
Yes.
And did you invest in the IPO markets during that boom bust?
I think personally, I was never a great investor myself, but of course I witnessed the whole process of the unraveling of markets. And it was seminal because it was a reminder that this is real. It's the so-called movement from Dalal Street to Main Street, if you like. It was now Main Street that was getting hurt. It was no longer just there were households across the country. Just as, subsequently when there were issues that happened at Unit Trust, maybe a decade later, again it was a reminder that these are not esoteric issues. So it was a very sharp reminder that these events are not about a small elite operating in their own bubble. These events actually impact a very large number of relatively vulnerable people who perhaps need to be better informed, but also better protected from the consequences of this. So I think that, so that was my memory, and I think many good things came out of it.
Yeah. So you call out 1992 as a very important moment. I agree with you. But despite that, for the next decade also, a lot of excesses got created, or a lot of mis-selling was perpetuated. For example, like you called out Unit Trust of India's, Unit 64 at that point in time was declaring NAV once a month. It was a closed-end fund with huge kind of spreads. And we didn't even know what an NAV was. It was much after, the so to speak, the scam was called out, that the computation of the NAV was done and then it was declared. And then you had all these assured return schemes, run by all the public sector banks and all of that. IPOs, obviously mispriced, missold. Morgan Stanley, first come, people will be allotted on a first come, first serve basis. All of that, like for a good 10 years, it seemed like, people really did not understand what equity market products were.
Yes.
So tell me about that period,
So,
and thereafter, what is it that really changed in your view that corrected this whole thing? Is it just a natural progression?
So I think actually that what happens tends to happen, and this is true not only of India, is that people remember the disasters better than they remember the achievements
Right.
of a particular phenomenon. So there were real achievements happening, which is that markets were being deepened, participation was increasing, cost of capital was going down because you had more liquidity. The first signs of technology investment to make market infrastructure develop were happening. And as I had said earlier, regulatory capacity was being built. So all of this was also happening in a very positive sense. The Unit Trust of India made a tremendous contribution to financial savings and democratization of access to markets by bringing people from every village in the country to participate in a way that they might never have otherwise participated in wealth creation. And many households benefited. Many had educated their children, sent them to college, paid for medical expenses. There were real married daughters, seen their, so managed their retirement. So there had been many positive consequences. Nevertheless, that doesn't, I think, excuse, if you like, the fact that from time to time people do unfortunately go off the desired path, and that's when you typically get these reactions. So so having achieved all of this, the temptation for one group or another, or one constituency or another, to seek arbitrage or unfair advantage is a global problem. It's in the nature of markets because they are an opportunity for wealth creation, and because there is information asymmetry, and the opportunity therefore is perceived to lie for somebody to seek advantage, which is why you need to regulate markets. That's where market failure, people are not necessarily all born saints. So given that, I think perhaps where we, with hindsight, could have done better was to have anticipated this and been more alert, intervened earlier. Now, these are lessons that we have learned over time, that if you keep your eyes only half open and you think it's okay to have a little bit of impropriety, but not too much in the system, you very quickly lose control of the moment when you will have perhaps more impropriety than you can bear.
Right.
And I think that's how these problems build up, is that you are aware that there are practices which are not healthy, but the overall show is on the road and going well. So there's a tendency to step back and say, perhaps we don't need to, look too hard at some of what is happening, because on the whole, for the greater good, this is still going in the right direction. And I think regulators all around the world have learned to their cost that is a very unsustainable position, because when you do that, you have essentially lost control, as I said, of when the accumulation of events will overpower you, which is what has happened periodically, time and time again. So it is a difficult balance to strike as you develop markets, as you liberalize markets, as you create more freedom, and as you have human tendencies towards greed and fear, which are the two dominant emotions, as you know, in markets at play and human psychology. It's a very volatile mix that you are creating.
Correct.
And it is combustible at all points.
Correct.
So certainly my view has been, therefore, it is better to intervene early.
Right.
And to create much clearer definitions around market practice and so on, and not to blur the boundaries in the hope that perhaps people will behave or not, be the straw that breaks the camel's back. But that's a personal view.
That's exactly
that
what I
we've had.
wanted to ask you is because financial markets, in fact, private capital thrives on opacity. I mean, you look at US markets, there are SPACs. In fact, regulators may, keep on upping the game by having, setting higher standards and best practices and upping the disclosure levels and transparency and all of that. But somehow, yeah, market participants are always leaps ahead and find opportunities to,
That is true.
game the system and find cracks. And for a country like India, I mean, often this is when we talk about the economy, people argue that, well, let's close our eyes to some level of corruption because it greases the wheels and allow the economy to work, than to completely, put a speed breaker on them. With respect to, securities market, is that approach advisable at all?
Yeah, no, I think that is the central tension as to how do you balance innovation with regulation, because you do want markets to feel free to innovate and regulate, and the sponsors of ideas such as SPACs and many others have always argued that this is pro-innovation, pro-regulation, because you are creating instruments that otherwise wouldn't exist, and you are doing it for people who should be sophisticated enough to understand what the risks are. So why should a nanny state or so I actually happen to think that policy frameworks or regulators should be bold enough to take a stand on these issues earlier rather than later. Ultimately, if on balance, the functional value of a so-called innovation is outweighed by the potential risks of misuse, it's better to call it out earlier. And if you look at the experience of SPACs, which is just one example that you've used, the empirical evidence is that it has not brought any functional value to the markets as such. So with hindsight, when you analyze the recent experience, it doesn't appear to have improved. Has it improved pricing? Has it improved market efficiency? Has it improved returns? And you say, what was that about, right? Was it just a little self-serving scheme which benefited a few well-positioned individuals at a point in time who essentially grabbed an arbitrage opportunity when markets were hot and greed was the dominant emotion as opposed to fear? You don't launch SPACs when there's fear, you launch it when there's greed, right?
Yeah.
So I think it is difficult, I know, and I'm not pretending that it's ever easy for regulators to know how to act. But again and again, I would keep stressing that you have to have the courage as a system, and it's not just a regulator's issue, it's a broader policy maker's issue, to understand the difference between functional value of innovation and the need to protect and treat participants fairly. So there are often so-called innovations which are positively harmful.
Sure.
And we should be ready to call that out earlier and not being popular is overrated if you're a policy maker or a regulator, in my view.
Sure. Now, like you also said, in 1992, early 90s, in fact, up until 2000 also, the nature and character of the market itself was very different from what we see today. If you look at the sophistication of market intermediaries, brokers, other characters, I mean, all of it was, very different. Today, we have research that is absolutely commoditized. You can, a retail investor can get as many research reports that he wants to on any given company, even a small cap company. At that time, even a one-page report on a Reliance Industries would be, rare to come by. So tell us, how have the market ecosystem itself changed? And let's say at McKinsey, when what kind of conversations would you have around markets with companies and participants, and how different is it now?
I think it's vastly improved. I think, first of all, the quality of our institutions And I would really call out that it's technology, it's operations, but it's also just general execution ability is eons ahead of where we were 2.5 decades ago. So we have some of the most evolved market settlement systems, market clearing systems. We clear volumes which were unimaginable some years ago. And this has happened because we have created the clearing corporations, the stock exchanges, the stockholding corporations, the custodians. And I think this has therefore been a very deliberate exercise. And these institutions in turn have been learning institutions and have evolved and created capacity and operate with a lot of energy and vibrancy today. They are not stagnant institutions. So that is one very big difference. The second is our ability to introduce thoughtful regulations which create boundary conditions and guide rails for how market intermediaries work. Because while market intermediaries are essential, again, we have had periods in recent history where market intermediaries were part of the problem as opposed to part of the solution. So there was a need for conscious intervention. Some may argue the pendulum swings too far now and then, but I absolutely endorse the view that there was a need for regulation because some bad apples were unfortunately contaminating the ability of the entire segment to operate effectively. So there was a need for some of this to be excised from the system. And I think that was undertaken. And that's been another contribution, I think. We weeded out and pulled out many of the bad apples, if not all of them, from the system, and created a framework where it became possible to succeed on sound, sustainable principles, which in turn has led to a certain amount of consolidation, which in turn has led to more trust on the part of investors, which in turn has helped grow the industry. So it has become a virtuous cycle that as you have more trusted intermediaries, you have more sustainable business, and you have more willingness to participate in the industry as well. And earlier that was a disincentive for people to come into the market outside of a very small group. And I think the creation of virtually new industries around insurance and mutual funds, asset management in the last 15 years has again been very transformational for Indian households because this has really helped bring, and again, I will caveat for you, has there been some mis-selling? Has there been processes? Absolutely there has.
Yes.
Has there been a need to intervene? Is that a work in process? Again, another good example of why there is no rose-tinted view, that every time you move forward, you will find as many thorn bushes as rose bushes on that path. And so we have navigated that quite well. But the net result of this is that you today have had a generation which has participated in wealth creation in a systematic, sustainable way. And financial inclusion is becoming is no longer just a dream, it's becoming a reality. It still has a long way to go. I think there are still far too many Indian households who either don't, of course, have the ability, but there are even some who have the means but don't have the access to participate. So we have a long way to go in terms of deepening inclusion, participation. But this is truly, again, something which is very, very inspiring to me in terms of India's market development over the last few years.
Sure. I remember that I think in the 2000s, 2002 or so, our equity participation was perhaps just 2% of financial savings was in equities. Now, of course, that number has improved. I won't say vastly, but it has improved nevertheless. So, who do you give credit for this? Is it the way the interest rates have moved, or is it the way the mutual funds have sold themselves? Is it just general confidence and trust that the regulators have been able to build for the entire ecosystem? What is it that has really pushed this forward?
As you know, there is
a bit of all.
There's a bit of everything there, of course. But I think the it has to start with an entrepreneurial class. So if I had to pick one thing to start with, it would be an entrepreneurial class. Sometimes maligned in our country, hopefully less so these days than maybe some periods of our past history post-independence.
Why would you say that? Because even today we see at the peak of the markets, you have substantial amount of equity being just offer for sale from private equity investors or venture capitalists, or so.
I think no. So I think the entrepreneurial class has been the bedrock of the evolution of our markets, because without substance to the wealth creation opportunity, you will have
nothing.
a mirage.
Right.
So underlying the successful development of our markets is indeed the process of reform, which enabled the re-emergence and so-called animal spirits of an entrepreneurial class in India that was able to set about building great businesses in this country. And this is something which is recognized around the world, that India does have, in a way that not all other emerging markets of the time had, a capable entrepreneurial class. And so we have built many great companies, which I think everyone understands has been the case. And that was what allowed then the emergence of all the other ecosystem players to develop. Once you have that, yes, of course, you will have intermediaries who will step in to serve that entrepreneurial class. Once you have that, you have the ability to attract institutions and households into the provision of savings, and then you have the incentive to create market infrastructure and so on. But of course, they feed on each other. They're symbiotic. Because you have high quality market infrastructure that builds trust, you tend to get more households willing to participate. Because you clean up the intermediary segment, again, you draw in more capital. So it's been an interconnected ecosystem, but the bedrock to me has been our ability to create outstanding companies based around the entrepreneurial history and tradition this country has, and that continues to be the bedrock. And again, of course, there have been examples where there have been missteps in that process. So, life is not perfect. So of course there have been examples where there's been misuse, abuse, and so on of the privileges that are extended. But you absolutely can never throw the baby out with the bathwater in that regard. And we have tended to learn from this. Where there has been a big governance failure, sometimes it has set us back. But I'm happy to say actually that on the whole we've kept moving forward, having learned hopefully some new lessons from that.
Sure. Mr. Puri, markets have arguably become a lot more efficient because of the sheer vastness of the transaction base. How has this changed the character and behavior of, let's say, the institutional participants and the retail participants in the markets? Has it changed the character, behavior, how people deal in markets? Has it changed their behavior in any way?
Yeah, so first it's changed the nature of players. Today our markets attract global players, and we are probably again a top 5 equity market today. So it's a very significant position we hold, maybe top 6-ish. But so we have attracted global players who bring with them again a level of momentum, sophistication, practices which are increasingly influencing how our markets operate. Second, we've actually lowered the cost of capital for Indian entrepreneurs by doing that, because as opposed to being dependent on a restricted supply of banks essentially and the pricing associated with that, we now have capital market alternatives, of course, both equities and bonds and other securities. So the cost of capital has come down for Indian entrepreneurs, which again in turn has helped fuel growth in the economy. Now interest rates, monetary policy, etc. are an aspect of that, but they are not, to my mind, a primary driver. They're more like a regulator on an engine. But the engine is essentially the process of building great companies and mobilizing capital for it. The regulators around interest rates, liquidity, currency rates, and so on are what also have to be managed in terms of stability and making sure that a car with a good engine is driven in the right way. But you need the good engine in the first place, which is where good companies with good, with access to capital, low-cost capital, comes into being in the first place. So I think that's where our attention should be primarily focused. I think the increasing interest in India from households in markets is a double-edged sword. It's a very good thing on the one hand, because I do believe that it's important that Indian households should participate in wealth creation. Wealth creation does mean that they need to actually have access to the fruits of entrepreneurial activity in the country. And the best way to access that is through capital market structures. But again, there are hazards in their attempts to do that. Now, the mutual fund industry, asset management industry has been one vehicle through which they can gain safer access. I'm personally not a fan of encouraging everybody on the street to take up trading as an activity. Some people think that would also be a good thing.
That's definitely one ill that the pandemic has caused.
It's something again which is a universal phenomenon. The willingness to take risks, some would call it, almost a form of gambling and so on. So these are deep-rooted human instincts. And I guess it's a judgment call how far you indulge those. But we've seen both happen. We've seen increased participation through institutionalized platforms like asset management and insurance. We've also seen increased participation through direct trading. And both have grown. And that means you've clearly got much more access. It is better regulated today. I think they are much better protected. As regards mutual funds and asset managers, a lot of regulations exist to avoid abuse in terms of investment process, as well as extraction of fees, opacity of costs. I think there are many things to commend our system for in bringing clarity, transparency, and trust to that system. In terms of direct market access trading, I think that continues to be a work in process. I think a lot of people are going to get hurt. But the theory is that if they are sophisticated, so-called sophisticated investors, who are we to stop them?
Right.
And I think at this point, that is sort of where the debate is. But I'm not convinced that is necessarily a good trend.
Is there a role for regulators to play here? Because there was a joke going around, last week when the GST on online gaming was increased, saying that now F&O volumes should shoot up because people have an alternate, a gaming platform right here. So how should regulators, do they have a role to play at all here?
I think education, awareness is fine. I think taking a very heavy stick to the problem is always problematic, unfortunately. It's a matter of how much do you want other people to interfere with your personal choices. So it's really an issue outside of economics, and it comes to the heart of liberal theory on societies. And if you are a liberal society, it is very hard to say to somebody, I don't think you should be taking this risk, even if you believe you have the right to take it with your money, with your eyes open, and in the way that you want. So I think it is genuinely difficult to have, and I, on the whole, would rather have a liberal society. And since I would rather have a liberal society, even though I personally think it is foolhardy to encourage a casino mentality in securities markets, I would rather take that risk than have regulators who will have to intervene to the extent of telling people what's good for them and constraining the construct or concept of a liberal society that is
Sure.
free to make its own decisions. So it's a very difficult trade-off beyond economics. But honestly, I think we have to keep chipping away. All you can do is lay better and better guardrails, create more awareness, and but then the rest, honestly, if you want to eat meat and I don't want to eat meat,
Yes.
it's just a
Personal
version
choice.
of that society. It's about liberal theories of how you lead your life. And I think generally we are still a liberal society, so
Yes.
I'm happy about that.
Sure. So I want to take you back to your Warburg Pincus days and tell us a little bit about the contribution of private equity in the development of the corporate sector in creating this equity culture, because in the rest of the world, at least in the Western world, they were really damned because they were damned for cutting costs, bumping up debt, just to enhance the ROE, and then exiting and leaving the companies in lurch. But in India, if you saw some of the early investments, for example, Warburg Pincus was a big investor in Bharti, which was a huge wealth creator, and that was not a time Bharti was really a company that was sought after. So tell me the contribution of private equity in India. Has it been different from the experience in the Western
without
world?
disagreeing with some of your questions on aspects of the private equity industry globally, I think in India it has been a very positive force, because on the one hand there was a willingness to identify and back sectors which until that point in time had not received institutional support.
Right.
Because on the whole, banking systems, and ours is a banking system-led economy
Growth
at
model.
that point,
Yeah.
tend to be highly conservative. And so the willingness to take a longer-term view on relatively risky initiatives, but which might have long-term impact and benefit, is something that private equity was able to do. And I think has played a very important role. And even so, the development of the telecom industry, as you say, was certainly one example. But today, the development of much of our technology-led consumer internet has been similarly enabled. Have there been excesses? Undoubtedly. But are we still better off, despite those excesses, than we might have been had it never happened at all? Absolutely again. So the fact that we have had some blow-ups does not negate the enormous benefit that has accrued to our system from seeing some great companies. Many have fallen, and more will fall by the wayside. Some investors will lose their money. But as an outcome, we have created something we didn't have before, which is a whole ecosystem of well-established, purposeful, technology-driven companies bringing real value to society and to households. So I think that's a phenomenon which private equity has played a very, very positive role in enabling as well. So it may sound self-serving, but I actually have a view that in India, the role of private equity has been much more positive than negative. I will fully accept that there are many counterexamples where PE firms or VC firms should have been more thoughtful, more diligent, done more to provide governance, and there are many examples of those, of course, in the public domain today as well. That still doesn't negate the overwhelming sense of positive contribution that this industry has brought, and in my view will continue to bring it, because India is easily one of the most sought after destinations as we speak for private capital, not just public markets.
Mr. Puri, tell me, private equity is equity or debt in India?
Well, it should be equity, but I think what's happened is, as people would say, the capital structure of a company is quite fungible. So at the end of the day, entrepreneurs in India have tended to view the two as a little bit interchangeable. It's not ideal, and it's not legally perhaps a very pure view. And they will take whatever they can get. If they think they can get equity in some pure form, if that's available, they'll take it. If that's not available, they'll take it in whatever form they can. So, I mean, I think which is what your question is getting to. as you can call it whatever you like, but to them, it's a relatively fungible ability to fund their growth plans. And sometimes they will offer you a structure which will really be debt-like, and frankly not taking equity risk, but still classified as an equity instrument. So has that been a problem? I think if everybody involved knows what they're doing with their eyes open, it's probably still okay, and I wouldn't quibble too much with whether it's equity or debt. I think it's where you get less sophisticated investors who may not understand what they're buying or what instrument they're buying or what platform they're engaging in, that it is a bit of a problem. And
also, the minority shareholders don't always know what exactly that structure is, isn't it?
That is also true.
And therefore, my question to you is, what is your prescription to the regulator? How should they view this issue?
No, I think there's the question of disclosure is a very important one as part of the overall thrust on corporate governance. And shining a light and transparency is only a good thing. The thrust should be on continuing to push for it, because there is no other way than getting more sunlight on these issues. And we have made progress, but we could make more progress, because we have seen recent examples where, so for example, the requirement to disclose pledges that have been made, where you have equity, but the equity has been brought in by taking debt. So in reality, behind the equity is just more debt. And the company's founders have just been burdened with more debt, but the investor believes they have got a well-capitalized company, which they haven't, because at the top of the structure, there is still more debt. And some of that is facilitated by private equity, some of that is facilitated by other banks, some of that is facilitated by other funds. And so it's not just private equity who facilitates that, but a lot of financial institutions generally facilitate that. So it is true. So if that is going to happen, if it happens in a way that everybody knows it has happened, it will still be okay. And the answer to me is to keep pushing for transparency rather than trying to constrain the ability of entrepreneurs to access those funds.
Sure. Now you have to recall some anecdotes from your McKinsey days and your Warburg Pincus days. Tell me some anecdotes, interactions with entrepreneurs, Indian entrepreneurs. And today, when you talk to similar people, I mean, just give us some sense of.
Well, again, I can't take names, of course, but I can talk about differences in themes. So I think there was a time when you would have a conversation with entrepreneurs in India, and they would not necessarily immediately accept that the company's interests and their interests could actually be aligned. So you were always conscious that you were having a conversation which was on the one hand about the company and on the other hand about the owner of the company. Whereas the theory of efficient capital markets is that ultimately the two need to be aligned and intertwined, and that if the company prospers, the owners prosper, and if the company doesn't prosper, and so on. It was not at all common in the 90s to find
and
people
I wonder why.
who believe that.
Why? Because it was a simple story to tell if your business was okay, which actually there were some businesses which had decent ROE, decent numbers, and yet you would not see promoters really receptive of this idea of market cap growth becoming their primary source of riches. I think
it was a function of, again, different aspects. One was that at that point in time, markets were not that vibrant. Two, we had very tight regulations around how business was done and business growth. As you remember, we had restrictions on size and capacity and ability to raise capital and ability to grow and licensing. And so that had unfortunately broken the natural linkage between owners and their offspring, the companies they created. And they tended to hedge themselves accordingly because they felt that they couldn't completely rely on this child of
Yeah.
theirs to look after them, when they got older, as it were. So they used to hedge themselves by creating other pools of wealth. It's not completely, so today actually I've had many conversations where that understanding is
It
very
was
clear.
rational behavior based on the economic construct at that
It was
point in
rational
time.
behavior if you take into account that they were hedging themselves.
Correct.
Again, in a highly restrictive environment. And they didn't yet have full proof or evidence of how capital markets could be fully aligned with their ambition. And of course, you had somewhat less clear regulations as well. So today, all of those are in place. You have vibrant capital markets, which will reward you more than amply if you do well. You have much more freedom to operate as an entrepreneur and build businesses. Of course, some questions to be answered there, but generally much more than we used to have. And you generally have regulations where you have a decent playing field on how you can operate. So today I see much more alignment, and again, anecdotally, far, far higher. And I see that as a very, very big and encouraging shift that has happened. The other issue was on the role of boards. I think we've come a very long way. Again, we have quite a journey ahead of us, but I don't recall anybody talking about their board as a relevant institution in the 90s. It's
Right.
not even about whether it was good or bad.
Right.
It was just an issue
Unimportant.
of relevance, yeah.
Right.
Unimportant. It was just a place where a group of friends showed up, and they may show up on 25 of these things.
Correct.
Unclear whether they did anything other than sign a few statutory obligations that they might
Yeah.
have had for the most part. Didn't get paid an extraordinary amount, but it was convivial. They had a place to meet. They had enough of them, so it paid the bills. And so it was virtually not a topic of discussion and very low expectations. Today, there's a tremendous amount of really heightened expectations, actually, of what boards are expected to do, a desire for much more accountability, and a regulatory push to accelerate that. So again, when I talk to people who are board members in the old days where it was just a tick that they were part of a club, today there's a sense of, I would say in some cases, concern, but that's a good sign because it's a serious job and you should be concerned if you take the
Yeah.
responsibility. But also a little bit of excitement around the ability to contribute meaningfully and therefore attract better people. Again, we have quite a way to go there, but I see that as a big shift, and I see that as a change which is positive from my conversations.
Sure. But how profound is this change really? Because even today you see actually boards around the world, not just in India, are a self-selecting mechanism. So does that not condemn them to this group think and the perils associated with it?
Yeah, it is still a problem that boards are not as open or as diverse or are constituted on principles of open meritocracy
And true
Yeah.
diversity.
and
In terms
true
of-
diversity. I think that is still an issue to be addressed. I think today we are probably halfway through that journey. I think people understand where the principles lie, but they have not yet put them all into practice. So we are kind of halfway there, where good boards are trying to achieve genuine diversity, bring a range of capabilities, and create the space for those boards to question, contribute, dissent if need be, in a way that was unthinkable some years ago. But that is we still need to pick up the pace on that. If you were to ask me, one of the areas I would pick where the future development of capital markets needs more support, it is in the process of accelerating genuine, high quality board governance. In India, but as you say, in the rest of the world, but we don't have to wait for the rest of the world.
Yeah.
And it's no excuse to say that there are board failures elsewhere in the world, because nothing that gives us more pleasure in India than to say, well, look at what happened at Enron and look at what happened, as if that somehow justifies or completely explains away, what may have happened at Satyam or somewhere else in our own backyard, which is a nonsensical argument. Of course, I think any school child knows that's a nonsensical argument. So these are absolute standards, and we should view them as absolute standards and really raise our aspiration now.
But how do you think that's going to change? Because it's not something that can be enforced.
It can't be enforced. I think it has to come from, of course, institutional shareholders. I think it play a very big role. And I'd highlight one of the things that has happened in India is a willingness, again, much slower than I would personally like, but a willingness to start to engage on the part of institutional shareholders on matters of governance, including board composition and accountability. And you need to see much more of that, because they are a very big influencer of this trend. So whether it's insurance companies, asset managers, private equity funds generally try and do this. They are a little more proactive. But institutional investors have to take the lead more than regulators, which is why you have this thrust in the West around stewardship and so on. Because money talks. They're the ones who have the money. And that will ultimately be, I think, what will...
But one of the things that perhaps changed governance practices, you can argue the other way also in the Western world, is activist investors, and somehow that is not a piece that most, at least in Indian regulators, don't view that as a particularly positive, participant in the market. So, in the absence of that, is the change really possible? Because
I think there's a bit of semantics there, because if you're an engaged investor, that's a good thing. Now, does engaged and activist mean the same thing? I mean, if you want investors who will get engaged, some of them may look like activists. So is an investor who calls for a change in CEO because they're dissatisfied with company performance being activist? Or are they simply doing their job as stewards of the company and putting their thoughts on the table and asking for a vote? I think the risk of activism in the negative sense is actually very low in India. And I think it should not be used as camouflage to prevent engagement. And I fear sometimes that this talk about the troubles of activism prevent us from engagement. We should cross that bridge around activism when we've at least got engagement. Today we don't even have sufficient engagement. So get engaged and worry about activism later, as opposed to worrying about activism and further slowing down the ability to engage, because that's a fiduciary, frankly, omission. And so I would like to see much more engagement. Others may call it activism. So I'm not worried about an excess there at all, quite the contrary.
Sure. So a little bit on technology, how has technology really changed the landscape for us so far? And how do you see the next 10 years, or if you just crystal ball gaze and say, how are capital markets going to be more efficient, or what will be the profound changes that will come about in the next 10 years? What would those points be?
None of
because
this
it seems like we have really come a long way, and markets are, in terms of efficiency of settlement, or in terms of laying the way we know it, dematerialization, or any of those things, we've pretty much achieved, it looks like, everything.
Absolutely. You've said it all there. I think none of this would have been possible without a massive leap in technology. None of this, the scale, the efficiency, the participation, the reliability, the trust, none of this it's all ultimately resting on major technological shifts and the capacity we built in India to manage these transitions. So that is the bedrock on which we built this edifice. So I think that is changing, generally for the better, in my view. You will have, people are talking today about artificial intelligence, which is a very, so the two big trends people talk about are artificial intelligence and blockchain. They have some amount of faddishness about them, but they are more than that. Artificial intelligence will bring a tremendous amount of further efficiency, transparency to markets. Of course, there's a question as to whether it will replace jobs and so on, which is yet to be seen. Well, might, possibly, or just change the nature of jobs. Blockchain will again further simplify market structures, because a lot of the layering that we have in markets, and therefore some of the inefficiency, could get eliminated through essentially distributed ledger technology, which is what blockchain is. I'm not talking about crypto, obviously. But that is again, it carries some threat for institutions like stock exchanges and others, because there's a question about what will their role be, where you actually have these mechanisms for direct settlement and clearing and so on. Why do you need these large platforms? So a certain amount of fragmentation may occur as that happens, and the regulators will have to try and think through with some crystal ball gazing on the positives of these technologies, but also around the impact on liquidity and fragmentation of markets and so on. That will be a consequence of these shifts gaining momentum. It's going to be unstoppable, in my view.
So would you go as far to say that the broking industry itself could disappear? Because what is the role of broking industry when, you've taken, the exchanges can pretty much take care of everything?
Yeah, I think the impact of AI, distributed ledger, and those emerging technologies, absolutely. Broking industry, not just the broking industry, but merchant banking, investment banking, investing, all of these central professions today, all will be impacted quite materially. It's less about will they disappear as to how do they change, what do they become, because you will, I believe, continue to have a need for services, for professional services in the space, but they're not going to be in the form that we have them today. So the current structures, I think, will start to look redundant. And this has happened in a number of industries. I mean, it's an ongoing process. You need fewer postmen today than you did yesterday. It's that kind of thing ultimately. You will still have mail needing to get delivered. You will still have messages that will need to get created. But there are different types of institutions that manage that. And I think it's very similar. So yes, it will feel disruptive to the industry, especially those that are slow to adapt. But I don't think it's going to be the complete destruction of the need for professional services. But this reformatting is going to be very quick, very severe. And some of the institutions, many of the institutions we need today across the system, investment banks, brokers, exchanges, are certainly not going to exist in their current form, a decade from now, for sure.
Sure. Mr. Puri, last question. Any capital market personalities that you really admire over the last 30 years? There have been several people who have shaped policy, several, market personalities who have sort of inspired investors. If you were to call out 2 or 3 people whom you think have contributed immensely to capital markets.
So on the policy side, and I'll take it by different segments. On the policy side, I do have the conventional view that what happened in '92 was seminal. And I do think, therefore, that what happened under that administration of
G.V. Ramakrishna.
I think you had people who were real giants in different parts of our system. Starting with, of course, finance minister at the time, Manmohan Singh, G.V. Ramakrishnan, you had the RBI, Rangarajan. You had a group of people who I think were, in some ways, to me, the founding figures of the shifts that started to happen. And I do give them credit for finding a way to help the country transition at that point in time. So I see that as a very, very seminal moment. And then, beyond that, I think people who've helped build great institutions in this country. I've always admired institution builders. Of course, Deepak and his uncle, Deepak Parekh and his uncle H.D. Parekh, between them, I think have made a major contribution. I think Mr. Pagal and Mr. Kamath made a major contribution. I think Aditya Puri's built an institution which I think has made immense contributions to the financial system in India, as has Uday Kotak. So I have a fairly conventional view that ultimately tends to perhaps be biased towards those who help build institutions as opposed to the individual brilliance.
Who created private wealth.
Individual brilliance of many people who are often in the public imagination stars of the system, and there have been many of those too.
Sure.
And they too, in their own way, they have been inspirational because they have drawn people in who wanted to be like them.
Sure.
So I don't begrudge them that honor. But personally, this is the tendency that I tend to see. Mr. Fairvani, of course, Unit Trust and so on. These to me are the great contributors because they built lasting legacies that I think will help us all succeed.
Do you have a favorite stock market story?
I am not a big investor myself in the stock market, but I do think the stock market is it's the best of times, the worst of times for many people happen in the stock market. So it's a stage, and it's a stage where human life plays out. It's not necessarily in itself an object of evil or of good. It is just a stage. And a lot gets enacted on that stage. And I think it's therefore such a living, vibrant part of people's lives that it will rightly, I think, continue to command a lot of interest from every aspect of society, from households, regulators, policymakers, adventurers, moralists, do-gooders. And so I find it fascinating. So to me, the stock market is just a wonderful place to observe every aspect of human society and an attempt to manage all the contradictions that we have to go through, as we journey through life. It's just another manifestation. But it's been a very positive part of India's history, and I hope it will continue to remain so.
Oh, absolutely. Thank you so much. It was such a pleasurable conversation.
Thank you so much, Malak. Thank you.